The date that the petrodollar died may already be on the calendar, and almost nobody is talking about what actually happened today. While Washington and Tehran trade ultimatums over ceasefire timelines, while oil markets swing 11% in a single session, while California drivers stare at $9 a gallon at the pump, a single quiet process has been set in motion in a parliament building in Tehran that could permanently restructure how the world prices energy. Not in 10 years, not after some future negotiation. Right now. Today. Here is the fact that changes everything. Iran is already collecting transit fees at the Strait of Hormuz, and those fees are being paid in Chinese yuan, not dollars. Yuan. The Secretary General of the Gulf Cooperation Council confirmed it. Industry specialists tracking live commercial shipping confirmed it. And Iran's own parliament is actively drafting legislation to formalize the toll structure into permanent law. Think about what that sentence actually means. The world's single most important energy choke point, the waterway that carries 20% of all global oil and natural gas, the geographic bottleneck that every Gulf producer depends on to reach its customers, is now operating as a yuan-denominated toll booth. The petrodollar did not end with a speech. It did not end with a summit. It is ending right now, quietly, one tanker transit at a time, while the headlines are focused on everything else. This is what we are breaking down today. All of it. This standoff has been escalating since February 28th, when this crisis formally began. And the scale of what is now happening at Hormuz is, by any historical measure, unprecedented. The International Energy Agency described the current supply disruption as the most severe in recorded history. Their exact framing. Worse than both oil shocks of the 1970s, and worse than the impact of the Russia-Ukraine situation on European natural gas, combined. We are not in a situation comparable to 1973 or 1979. This disruption is 3 to 5 times larger by the volume of supply removed from global markets. In response, IEA member nations agreed on March 11th to release a record 400 million barrels of oil from strategic reserve stockpiles to address the shortfall. That is a significant number. It is also a temporary cushion. When daily throughput at Hormuz drops from 20 million barrels to roughly 5% of normal flow, no strategic reserve release covers that gap for long. The price signal has been brutal. Brent crude hit $126 a barrel at its peak. Goldman Sachs revised its forecast upward, projecting Brent averaging $110 for March and April, a 62% jump from the 2025 annual average. Goldman also noted that if Hormuz flows stay at 5% of capacity for 10 weeks, Brent would likely exceed the all-time record set in 2008. In California, fuel prices are already pushing $9 a gallon. That number is now part of the political conversation in Washington. Trump gave Iran a 48-hour ultimatum on Saturday. Reopen Hormuz or face a direct response against power plants and energy infrastructure inside Iran. Iran's answer came through its military command. If that threat is carried out, the Strait of Hormuz will be completely and permanently closed until every piece of damaged infrastructure inside Iran is rebuilt. Iran's parliament speaker went further, stating that critical infrastructure across the entire region would be treated as a legitimate target in any escalation scenario. Trump then announced on Monday that weekend talks had been productive. He said he instructed his team to pause any action against Iranian energy infrastructure for 5 days. Brent dropped nearly 11% on that announcement, falling from above $112 to $99.94 in a single session. West Texas Intermediate dropped more than 10%, falling to $88.13 per barrel. The market moved on the word productive. But here is what happened the same day. Iran's foreign minister looked directly into a camera on state television and said his government has not engaged in talks to end this standoff and does not plan to. He said Washington had attempted to send messages through third-party nations, but he called that not a conversation and not a negotiation. The gap between Trump's characterization and Iran's is not a misunderstanding. It is two sides telling two completely different stories to two completely different audiences. The market is going to have to figure out which one is accurate. Meanwhile, Iran's new supreme leader, Mojtaba Khamenei, broke his silence this week and delivered a direct statement through state television. The Strait of Hormuz stays closed, and Iran will continue its pressure campaign against neighboring infrastructure, a new leadership, and the same strategic position as the old one. The humanitarian and economic cost to Gulf producers is being described in staggering terms. Kuwait Petroleum Corporation CEO Sheikh Nawaf al-Sabah stated this week that Iran's control of Hormuz is an economic blockade against the entire Persian Gulf. Kuwait has declared force majeure on its delivery contracts. The country was producing around 2.6 million barrels per day before this started. Right now, they are producing only enough for domestic consumption. They have shut down wells. Restoring full output capacity will take months once this ends, because closed wells cannot simply be switched back on. Saudi Arabia's position is equally serious. The Ras Tanura refinery, the kingdom's largest facility processing 550,000 barrels per day, has had to shut down. Saudi Aramco's CEO had already warned in early March that the consequences for the world economy would be catastrophic. The kingdom has been rerouting production through the east-west pipeline to the Yanbu port on the Red Sea, which bypasses Hormuz entirely, but that pipeline maxes out at around 5 million barrels per day. Hormuz was carrying 20 million. The math does not work. Saudi Arabia has been cutting Asia-bound shipments to manage the gap. The UAE has also had to close its largest refinery. Qatar, the world's second-largest LNG exporter, has shut down production. Qatar and the UAE together account for 30% of China's LNG imports, 53% of India's, and 72% of Bangladesh's. The ripple through Asian energy markets is not a secondary story. It is the central story for hundreds of millions of consumers across the continent. And the alternative bypass routes are under pressure too. The Abu Dhabi crude pipeline to the port of Fujairah, designed specifically as an escape valve from Hormuz dependence, has already come under Iranian pressure. The Red Sea option faces complications from Houthi-aligned activity in that corridor. The world built theoretical workarounds for a Hormuz closure. In practice, every one of those workarounds is either capped well below required volume or is compromised. Now let us get to the deficit picture, because this is where the long-term dollar damage compounds on itself. The U.S. deficit this year is on pace to hit $2 trillion, and that figure does not include the full scope of expanded Pentagon spending as this standoff deepens. Treasury Secretary Bessent came into this year with a specific plan. He wanted 3% real GDP growth. He wanted the deficit reduced to just 3% of GDP by 2028. That plan has been overtaken by events. The 2026 deficit was already projected at 5.8% of GDP before this crisis began. Factor in an additional $200 billion from defense spending, and that number clears 6.7% without any further complications. The cascade on interest payments is where this gets genuinely alarming. When rates stay elevated for an extended period, the government spends more each year just to service existing debt. That increased interest spending expands the deficit, which grows the debt, which grows the interest bill, which expands the deficit again. By 2036, some projections put the deficit to GDP ratio at 8 or 9%. That is not a fiscal management problem at that point. That is a structural impairment of the dollar. Which brings us back to Hormuz and to the Yuan toll that opened this video. Because what is happening there is not simply a supply disruption. It is the active construction of a parallel financial system. Iran is not just blocking vessels. It is selectively allowing passage based on criteria it controls. In early March, Iran announced it would permit Chinese vessels through. Ships have been transiting after broadcasting Chinese ownership status. The Iranian foreign minister offered Japan safe passage given their energy dependence, noting that Japan gets 95% of its oil from the Middle East, 70% of which transits Hormuz. Tehran is using access to Hormuz as a tool of differentiated diplomacy, creating a world in which your relationship with Iran determines whether your energy supply gets through. And now the toll is confirmed. Over 150 vessels transit Hormuz in both directions every day. A standardized fee in Yuan on each of those transits generates billions of dollars in monthly revenue for Tehran. That is a permanent new income stream that did not exist before February 28th. But the financial significance goes far beyond the revenue itself. Iranian officials have stated they would allow cargo through Hormuz under one condition: payment in Chinese RMB. This creates a de-dollarization mechanism that is now operational, not theoretical, at the single most important energy choke point on the planet. The United States spent 5 decades ensuring Gulf oil was priced in dollars, specifically because dollar oil pricing created structural global demand for the currency. Iran is now running that logic in reverse. Deutsche Bank identified this as a potential trigger for the Petro-Yuan even before this standoff began. Their estimate: between 10 and 20% of global oil trade could ultimately convert to yuan settlement if Iran enforces this mechanism at scale. Consider that Saudi Arabia sells 4 times more oil to China today than it sells to the United States. Most of that still clears in dollars. The key word is still. If Iran is charging yuan at Hormuz and Saudi Arabia needs to move oil through Hormuz to its largest customer in China, the path of least resistance starts to shift. According to Deutsche Bank, over $30 billion in oil trade could flip to yuan settlement immediately from Saudi transactions alone. Then add the UAE, Qatar, Kuwait, and Bahrain. Every barrel from every one of those producers transits the same choke point. Kuwait's CEO described what comes next as a domino effect. He was talking about economic disruption, but the same framing applies to the financial architecture. Now look at what is happening in the capital markets while all of this unfolds. Since the standoff began in late February, U.S. Treasuries have sold off. G7 sovereign debt broadly declined. Yields climbed across the Western financial system. Traditional safe haven assets failed to perform the way they historically do in a crisis. Japanese bonds lost ground. The yen weakened. Chinese bonds held steady through all of it. When gold was falling and Western debt was declining, Chinese bonds did not move. That is a significant signal. It tells global capital markets that China is structurally insulated from the supply chain disruption that is upending everyone else's asset values. The reason is straightforward. China's industrial economy is not dependent on Gulf oil the way Western economies are. Years of investment in solar, wind, and nuclear capacity mean Chinese manufacturing can absorb an extended Hormuz disruption without the same operational impact. On top of that, China is actively pursuing a policy of opening its capital markets to international investment and targeting a structurally stronger RMB over the medium term. Sovereign wealth funds and institutional investors looking at those Chinese bonds right now are looking at an asset that held value during a period when almost everything else in the global system was declining. That makes the yuan toll booth at Hormuz much easier for Gulf finance ministries to rationalize as a transition worth making. Russia is watching this development closely too. The Kremlin this week explicitly noted that rising global oil prices are benefiting Russian state revenues. Russia has its own long-term interest in a world where Gulf oil pricing shifts away from the dollar. The block that gains from a weakened petrodollar extends well beyond Iran and China. This is a structural realignment that serves multiple agendas simultaneously. Iran's parliament speaker described the situation at Hormuz this week as a high-risk opportunity, a strategic trap that was stepped into during a period when Tehran was actively engaged in diplomatic negotiations. Iran did not start with the intention of closing the world's most critical energy corridor, but having done so, they are now extracting maximum strategic and financial value from the position they hold. The yuan toll is not an accidental side effect of this standoff. Based on everything we are seeing, it looks like one of its primary strategic objectives. Now let us look at the infrastructure layer, because this is where the transition from theory to reality becomes clear. Saudi Arabia has been participating in China's Project M-Bridge for several years. That is a cross-border digital currency settlement system designed specifically to process transactions outside the SWIFT network. No dollar clearing, no U.S. financial oversight. Settlements happen directly between the People's Bank of China and participating Gulf central banks. Saudi Arabia also has RMB swap lines with China worth 50 billion RMB. With China paying in yuan for Saudi crude, Riyadh has immediate access to the currency without a conversion problem. The payment infrastructure exists, the relationship exists, the swap lines exist. The missing piece was a concrete forcing mechanism. Iran just provided it. Saudi Arabia is the anchor of OPEC. When Riyadh makes a structural shift in how it settles oil transactions, the rest of the bloc tends to follow in some form. And there is an enormous volume of Gulf capital sitting in U.S.-denominated assets right now that has been held in place by the petrodollar arrangement. The Gulf states collectively hold over $8 trillion in global assets. Roughly $3 trillion of that is in sovereign wealth funds, with the rest distributed across central bank reserves and state pension pools. The vast majority of that $8 trillion sits in dollar-denominated instruments today. A rotation of even a fraction of that capital into Chinese stocks and bonds represents a significant structural reduction in demand for U.S. treasuries. It pushes the cost of U.S. borrowing higher at exactly the moment Washington is running a deficit heading toward $2 trillion a year. The two pressure points reinforce each other. The standoff at Hormuz expands the deficit while simultaneously eroding the buyer base for the debt that covers that deficit. Trump does not view the dollar's global role as the strategic asset it actually is. He has preferred a softer currency for years. And in the short term, a declining dollar does reduce some friction for U.S. exporters. But there is a fundamental difference between a managed gradual weakening of the dollar and a structural loss of the dollar's role in global energy pricing. The first is a policy instrument. The second is an irreversible loss of systemic leverage that took 5 decades to build. What happens from here depends on how the next several weeks play out. Trump has called the weekend talks productive. Iran's foreign minister says there are no talks and there will be no negotiations. One of these is accurate. The 5-day pause on further escalation creates a narrow window for something to shift. But Iran's own 5-point counter-proposal, which includes formal recognition of Iranian sovereignty over the Strait of Hormuz, is not a document built for quick resolution. It is a document designed to establish a maximum opening position from which any eventual settlement would still leave Iran in a significantly stronger position than before February 28th. And Iran's new supreme leader has made clear that the current posture continues. The leadership transition in Tehran did not produce moderation. It produced continuity. The IEA has called this worse than the 1970s. Kuwait has described a global domino effect. Goldman Sachs is projecting oil could break its 2008 record if this continues. And today Iran formalized what everyone already knew was happening. It is collecting Yuan at Hormuz, and it is building the legislative framework to make that permanent. The petrodollar system was not built overnight. It was constructed through decades of consistent policy, strategic relationships, and institutional arrangements. It will not collapse overnight either. But the mechanism being assembled at Hormuz right now is the most concrete structural threat to dollar oil pricing that has ever existed. Not a theoretical one, an operational one. One that is, as of today, already functioning. Leave your take in the comments. Does this standoff end with a deal that preserves the existing financial architecture? Or does the Yuan toll booth at Hormuz become the moment historians point to as the beginning of the petrodollar's end? Stay safe. Hit the like button and subscribe. We are going to keep tracking this every single day.